Income statement forecasting. Let us begin with the income statement forecast. There is usually a very close relationship between sales and cost of sales, or cost of goods sold. Many companies, in determining their selling prices, conveniently add a specific percentage markup or margin to the cost of sales, thus establishing a predictable ratio between the two items. If an enterprise decides to slap a 100% markup on its cost of sales, the sales figure will be double the cost of sales. Therefore, cost of sales will be 50% of sales. Not everybody, however, has the luxury of determining their own prices. Market prices tend to be relatively low in a very competitive business. Enterprises are forced to slap lower markups or margins on their cost of sales. Some even sell their goods at a loss. In determining the most likely ratio of cost of sales to sales in the future, one can use past patterns or ratios. Let's take a hypothetical company, XYZ. Sales for 3 years have been growing as shown in Table 27. The sales figures are converted to 100% over those 3 years to get a common size picture. Next, the cost of sales is divided by the sales figure to get a percentage or ratio of cost of sales to sales. After deriving the percentages or ratios, one can make a fearless forecast of what the cost of sales percentage will be in the coming years. The sales forecast for the next 2 years can be set to approximate the growth trend of the last 3 years. Since sales grew by 10% from 1997 to 1998, and by 10% from 1998 to 1999, the financial forecaster can reasonably assume a sales growth of 10% per annum in the next 2 years. The sales forecast for the year 2000 is thus 1,331,000 pesos, and for the year 2001, the forecast can be set at 1,464,000 pesos. The forecast for the cost of sales percentage is 70% of sales for the years 2000 and 2001, as given in Table 27. This percentage is merely an average of the percentages for the last 3 years. One can conceivably use the latest cost of sales percentage, 1999, to reflect the most current scenario. The next step is to apply the 70% of sales to the sales forecast for the years 2000 and 2001 to get the cost of sales peso value forecast for those 2 years. It is important to realize that if one expects inflation to affect major items in the cost of sales and in the selling prices of the company, then there is a need to adjust the forecast based on the inflation rate. A more meticulous approach to forecasting cost of sales can be taken by looking at each and every cost item included in cost of sales. The cost items can be broken into variable costs and fixed costs. Variable costs will rise proportionately to sales, while fixed cost will not necessarily change with sales. Raw materials, for example, will vary with sales. Labor may or may not vary, depending on whether they are paid on a piece rate basis, in which case they are variable costs, or a monthly basis, which make them fixed costs. Depreciation and overhead expenses are fixed costs, except for some manufacturing overhead expenses like power, which may vary according to power usage of the factory machinery and equipment. As mentioned earlier, one has to take into account the changes in price of various items in cost of sales due to inflationary or deflationary conditions. If the enterprise is operating under full capacity and the cost of sales contains a big percentage of fixed costs, then the rise in sales will not be accompanied by the same percentage increase in cost of sales, since the fixed cost items will not increase very much. In forecasting future cost of sales, therefore, the forecaster will have to assume a lower cost of sales percentage vis-a-vis the sales forecast. After forecasting sales and cost of sales, the gross profit figures can be derived by subtracting cost of sales from sales. The next step will be to forecast operating expenses. These are expenses that are not directly related to manufacturing the product or delivering the service of the enterprise. The salaries, rental, representation, and other expenses incurred by the headquarters, marketing, administration, finance, legal, and operations departments are part of operating expenses. Again, one can classify them into variable and fixed costs. Those that vary with sales will increase proportionally to sales. Those that are fixed will not vary with sales. However, these fixed costs may also rise because the enterprise may want to add head office personnel, increase salary rates, and adjust for contract escalation clauses. The financial forecaster can go through each operating expense item and determine how it will behave in the future as sales rise. The forecaster may not have all the information available to make a good guess. In such a case, the forecaster can then make reasonable assumptions that are defensible under existing or expected conditions. The variable costs that fall under operating expenses can be isolated. The forecaster should compute the ratio or percentage of the different variable costs in relation to sales. Once these ratios or percentages are computed, they can be used as multipliers for forecasting purposes. One simply multiplies the ratio or percentage of each variable operating expense item by the peso sales forecasted to get the peso forecast for the operating expense item. The fixed operating expenses have to be determined individually. Where the salaries and wages of head office personnel are concerned, will there be increases in the number of people? Will there be increases in their rate? For rental expenses, will there be additional space needed? At what rate per square meter? For depreciation of office furniture and equipment, one has to look at the depreciation schedules of existing furniture and equipment. After this is done, one has to add the depreciation expenses of additional furniture and equipment needed for incoming hirees, or to replace old furniture and equipment. Other fixed operating expenses have to undergo the same detailed analysis. Once all the operating expenses are computed, they should be summed up. The total is then subtracted from the gross profit forecasted in order to derive operating profit. The next step is to calculate non-operating income and non-operating expenses. Non-operating income comes from transactions not connected with the main business of the enterprise. This includes dividends from stock investments, interest income from money market placements, profit derived from the sale of enterprise assets, and other such activities. Non-operating expenses include interest expenses on short and long-term loans, losses incurred in the sale of assets or marketable securities, etc. The financial forecaster must estimate these non-operating income and expenses based on the investments made or about to be made by the enterprise, and based on loans incurred or about to be incurred by the enterprise. A detailed schedule of investments and loans should be done for this purpose. After non-operating income is added and non-operating expenses are subtracted from operating profit, we are able to derive the net profit before taxes. The taxes applicable are then computed following government rules and regulations, and then subtracted from net profit before taxes to arrive at net profit after taxes. Balance sheet forecasting. Forecasting what the balance sheet of an enterprise will look like in the future depends a lot on future sales. Let us start with the current assets of the balance sheet, which include cash, marketable securities, accounts receivables, inventories, raw materials, work in process and finished goods, and other current assets. Beginning with cash, one can assume that the enterprise will set a minimum cash balance, cash on hand or in the banks, in order to pay for the company's day-to-day expenses, taking into consideration the expected cash inflows and outflows from the operations of the enterprise. This minimum cash balance can be arbitrarily set to be equivalent to 10, 20, or 30 days of cash purchases and operating expenses. The choice will depend on the comfort level of the finance manager or entrepreneur. His worst nightmare is running out of cash to meet payroll expenses and critical purchases for the factory. Cash beyond the minimum required balance can be placed in marketable securities. If, on the other hand, the cash position is expected to fall below the minimum cash balance required, then the enterprise would have to sell some of the marketable securities or borrow money to bring cash up to the minimum cash balance set. The minimum cash balance can also be set as a percentage of sales, since many of the cash outflows, especially cost of sales and operating expenses, will tend to go up and down with sales. As stated earlier, marketable securities can be the repository of excess cash. It can be drawn down or reduced if the cash balance falls below the minimum required. Accounts receivables can be projected since these climb and slide with sales. If the enterprise has an average accounts receivables collection period of 1 month, then the forecaster can project accounts receivables to be 1/12 of projected sales for the next 12 months. More accurately, the projected accounts receivables at the end of the fiscal year of an enterprise will be the expected sales of the last month of that fiscal year. If the collection period is 2 months, then the projected accounts receivables as of the ending date of the balance sheet will be the sales for the last 2 months of the fiscal year. The enterprise can decide to be more strict or more lax with its collection policies. This will change the forecast accordingly. In forecasting accounts receivables, a straightforward approach would be to multiply the average ratio or percentage of accounts receivables to sales experienced in the past years, and then apply this ratio or percentage to the sales forecast of the future years. Inventories can be projected in the same way as accounts receivables. The enterprise's experience in its past inventory turnover can be used to forecast future inventories. Inventory turnover can be computed using past sales or cost of sales as the numerator and past inventories as the denominator. The resulting ratio or multiple, the numerator over the denominator, can then be the divisor used to forecast future inventories. For example, if past sales were 1,210 pesos and past inventories were 201 pesos, then the inventory turnover would be 6. If sales are expected to increase to 1,331 pesos the following year, then the forecaster can just divide 1,331 by 6 to get the peso forecast for inventories by 221. Another way of doing this is to use the ratio or percentage approach by dividing the inventories by the sales or cost of sales. The resulting ratio or percentage can then be multiplied to the expected sales to derive the projected inventories. Using the same example, divide 201 pesos, past inventories, by 1,210 pesos, past sales, to get 0.166 or 16.6%. Multiply 0.166 by the sales forecast of 1,331 to obtain 221, which is next year's forecast. Other current assets must be individually looked at. Prepaid insurance, for example, can be determined by examining how much premium will be required to insure the company's properties for the coming year. Advances to the employees is another item found in other current assets. It can be projected according to the experience of the enterprise. The enterprise may also decide to collect all of the advances and not give any more of such advances to employees, in which case the advance to employees becomes 0 for the next year. Forecasting fixed assets requires an assessment of the enterprise's future requirements for land, building, machinery, equipment, furniture, fixtures, and other long-lasting assets. The acquisition costs of previously purchased and still to be purchased fixed assets are added to comprise the forecasted gross fixed assets, or simply fixed asset. Next, the forecaster must subtract accumulated depreciation from the gross fixed assets. The depreciation expenses of all the gross fixed assets for the forecasted year are added to the accumulated depreciation of the previous year to obtain the accumulated depreciation for the forecasted year. By subtracting the forecasted accumulated depreciation from the forecasted gross fixed asset, one is able to compute the forecasted net fixed assets. The gross fixed assets include both the assets used on the factory floor and the head office building. The depreciation expenses embedded in the cost of goods sold and in the operating expenses are cumulatively added over the years to arrive at the accumulated depreciation. To determine the depreciation expenses, the forecaster has to refer to the depreciation schedules calculated by the enterprise's accountants for each fixed asset. Some fixed assets are depreciated over 3 years, some over 5 years, others over 10 years, and still others over 40 years. This would depend on accepted accounting practices, the auditor's prudent estimates, and government taxation policies. In making rough estimates of gross fixed assets, the forecaster can make simplifying assumptions. If the enterprise is thinking of increasing total production capacity by 50%, then the forecaster can roughly assume a 50% increase in gross fixed assets. If the enterprise is still operating below capacity, then the forecaster may assume that gross fixed assets will not change much, except for the replacement of some very old fixed assets. Gross fixed assets may contain capitalized expenses, such as leasehold improvements, which can be technically booked outright as a part of operating expenses, e.g., repairs, maintenance, and improvements. However, the peso value or total cost of leasehold improvements may be very large. Since these leasehold improvements will serve the enterprise for a long time, they can be recorded as long-lived assets that will be amortized or depreciated over 3 or 5 years. This yearly amortization of leasehold improvements is expensed and made a part of either cost of sales, if connected to the factory, or operating expenses, if connected to head office operations. Other assets include organizational expenses, goodwill, patents, etc. Organizational expenses comprise feasibility studies, enterprise promotion activities, pre-operating expenses, and other setup costs. These are likewise capitalized and amortized. Goodwill is the premium paid by the enterprise for an asset or share of stock whose book value is lower than the purchase or acquisition price. For example, if a company acquires an asset at a book value of ₱1,000,000 but pays ₱2,000,000 for it, the incremental million is recorded as goodwill. Patents are payments to holders of an invention or technology. What has not been discussed thus far are long-term investments made by the enterprise in other companies or projects. Since these investments have strictly nothing to do with the business of the enterprise, they are recorded separately as investments and are usually booked at market prices or acquisition costs, whichever is lower, for the sake of conservatism. Investments are usually presented in the assets column between current assets and fixed assets. The forecaster should ask the company treasurer or investment manager what his plans are for holding on to those investments for projection purposes. Shifting to the liabilities column of the balance sheet, we start with items in current liabilities. The first item is accounts payable or supplier's credit. This can be estimated by relating it to the purchase of raw materials or semi-processed goods. When an enterprise is expecting a sales increase, it prepares for this by increasing the production of goods, which means increasing inventories. Increasing inventories, in turn, means availing of more supplier's credit or accounts payable. Thus, increase in sales will also lead to increases in accounts payable. One way of forecasting accounts payable is to again get the past ratio or percentage of accounts payable to sales, and then apply this ratio or percentage to the forecasted sales in order to derive forecasted accounts payable. The forecaster can also use the ratio or percentage of accounts payable to cost of goods sold. More accurately, the forecaster can pinpoint the exact amount of purchases needed just before the forecasted ending date of the balance sheet. For example, if the forecaster is trying to estimate accounts payable outstanding as of December 31st, 2001, and assumes that the enterprise gets only 30 days or 1 month of supplier's credit, then the forecaster should determine the purchases needed for December, which will not yet be paid on that month, but on January 2002. This will be the accounts payable outstanding as of December 31st, 2001. Accrued expenses come next. These are expenses incurred during the accounting period concerned, but not yet paid during that period. These expenses include accrued salaries and wages, taxes payable, interest payable, and so on. The forecaster can do a detailed analysis of how each item behaves. The forecaster may discover that accrued salaries and wages are roughly equivalent to 1 week's pay. He may discover that taxes payable is a function of government regulations. If the taxes for income realized during the accounting period are allowed to be paid in the next fiscal year, then they will all appear as taxes payable as of the ending date of that accounting period. Interest payable can be computed by estimating the short and long-term loans needed for the period being forecast. The balance sheet forecast will, in fact, reveal the loan status of the enterprise. The forecaster can assume that any financing shortfall will be covered by additional loans. This will increase the total loans of the enterprise, thereby increasing interest expenses. The interest expenses incurred during the accounting period but not yet paid during that period will appear as interest payable as of the ending date of the same accounting period. As discussed previously, the forecaster can use either short or long-term loans to fund any shortfall in the financing of assets required for the forecasted period. What the forecaster needs to do beforehand is to forecast the stockholders' equity. If there are no expected increases in paid-in capital, then the only change in stockholders' equity will be in retained earnings. One can estimate this by adding the net income after taxes for the forecasted year, less dividends expected to be paid, to the previous year's retained earnings. This will give the new retained earnings as of the ending date of the forecasted accounting period. Once the forecaster has estimated the stockholders' equity, he can now go back to the loans. If the shortfall in financing is largely due to the acquisition of fixed assets, then the forecaster should increase the long-term loans accordingly to finance the shortfall. If the shortfall, however, is largely due to increases in current assets, then the forecaster can increase the short-term loans. If the increase in current assets is permanent in nature, meaning it is not a seasonal increase in current assets or working capital, then the forecaster may decide to obtain long-term loans instead. Here, prudent financial judgment is required. But for financial projection purposes, the forecaster can use a simplification technique as a first iteration in his effort to come up with a pro forma, or projected, balance sheet. He can conveniently assume that any financing shortfall will be financed by loans for the purpose of balance sheet balancing, and then adjusted for a more refined financial strategy. Of course, there are other ways to fund the financing shortfall. One can increase the paid-in capital, or sell preferred shares, or even beg for additional suppliers' credit. The previous paragraphs discussed the need for the balance sheet assets to equal liabilities always. Most probably, the respective totals of assets and liabilities will not be the same in the initial attempt to construct a forecasted or pro forma balance sheet. This is because each forecasted item is obtained independently based on the assumptions, policies, or regulatory requirements followed. Thus, there is a need to have a balancing account. The approach suggested earlier was to use loans as a balancing account. Alternatively, one can use the cash account. Instead of stipulating a minimum cash balance, cash can be allowed to go above the minimum balance or to go below that, even to the point of showing a negative cash balance. If the cash goes above the minimum balance, the forecaster can subsequently adjust the balance sheet by using the excess cash to pay for outstanding loans or to increase placement in marketable securities. If the cash goes below the minimum balance, the forecaster can cover the cash shortfall by obtaining more loans or by liquidating marketable securities into cash. The pro forma balance sheet, as of December 31, 2001, shown in Table 29, has still to be adjusted because the additional short-term loans of 8,000 pesos used to adjust and balance the balance sheet will create additional interest expenses. If the interest rate is 10%, then the additional interest expenses will be 800 pesos. This will affect the income statement. The 800 peso interest expense will reduce net profit before taxes by 800 pesos, but it will also reduce taxes due to the lower taxable income. The net effect is to reduce net income after taxes. If the tax rate is 25%, then the net income after taxes will go down by 600 pesos, 800 less 200, which is 25% of 800. The forecaster must, subsequently, increase the short-term loans by 800 pesos and reduce taxes payable by 200 pesos, for a combined effect of 600 pesos that will balance the reduction in retained earnings caused by the reduction in net income after taxes of 600 pesos. For illustration purposes, The pro forma income statement and adjusted pro forma income statement for the year 2001 are shown in Table 30. The pro forma balance sheet must be adjusted. Short-term loans will rise to 18,800 pesos. Accrued expenses will decrease to 6,800 pesos, and retained earnings will decline to 15,400 pesos. All other items will remain the same except for the subtotals of current liabilities and stockholders' equity. Funds flow forecasting. To forecast the funds flow, the financial forecaster should compute for the increases or decreases in the different items found in the assets and liabilities columns. When comparing the actual or previous year's balance sheet and the pro forma balance sheet. This has been described in Chapter 4, Interpreting Financial Statements. Decreases in assets and increases in liabilities are sources of funds, while increases in assets and decreases in liabilities are uses of funds. Cash position forecasting. To forecast the cash position of the enterprise very roughly, the income statement and the balance sheet forecasts can be used. This will not be exact because accrual accounting rather than cash accounting has been used. Adjustments therefore have to be made. As mentioned earlier, the forecaster can use the cash account as the balancing figure for the balance sheet by computing how much cash will be reduced or increased by the corresponding increases or decreases in the different balance sheet accounts. One can argue that there is a non-cash item called accumulated depreciation in the assets column. This is counteracted by the fact that a corresponding non-cash item called depreciation expenses has been subtracted from the income statement and consequently the retained earnings account. In short, they balance out. What the forecaster should do is adjust the reduction in the net fixed assets account caused by the increase in additional accumulated depreciation from the previous year to the forecasted year. This will, in effect, increase the use of funds by the exact amount of the additional accumulated depreciation. The effect on the contra entry, or the sources of funds, would be an adjustment in the retained earnings account brought on by adding back the depreciation expenses taken out of the net profit after taxes. If one assumes that the additional accumulated depreciation is 200 pesos, then this means that the depreciation expenses for the year is also 200 pesos. Other adjustments have to be made because of the accrual method used. Exhibit A shows how a detailed cash flow statement can be generated. A pro forma cash flow statement can be constructed using the pro forma income statement and balance sheet. The cash flow statement describes activities that generate increases in the sources of funds and activities that lead to uses of funds. Notice how the cash flow is categorized according to the net cash flow from operating activities, cash flow from investing activities, and cash flows from financing activities. The projected increase or decrease in cash for the year is added to the cash at the beginning of the period to derive the cash at the end of the projection year. For a more meticulous method of forecasting cash using expected cash inflows and outflows, refer to Chapter 7, Financial Planning and Budgeting.